What is going on, traders? Welcome back to the Traveling Trader. So the first major bank forecasts a US recession. We will get into all of that. We also have a very important update from the Fed. The FOMC meeting minutes from the March meeting is going to be released this week. The CPI data will also be released next week. This is the inflation numbers. And then, of course, we have the major earnings season kicking off. This will be the earnings season that first showcases the 2022 numbers. This is the earnings for first quarter of 2022. We definitely want to see how bad the effect of price instability and supply shock has had on the market, on the earnings of some of the biggest companies in the world. And lastly, April is historically the best month for stocks if you are just looking at S&P 500 data. So how is that going to play into this whole scenario with all of these factors bouncing around? Let us get right into it. This is probably the most important video, at least of 2022 so far. So Deutsche Bank becomes the first major bank to forecast a recession in the US. If we take a look at the details, they're saying that 2023, 2024, that's around the time frame that we are forecasting a recession. Now, this is not completely unfounded, right? I mean, we've talked about this before. The first reason that they're mentioning a recession in the first place is because of the inversion between the 10-year and the 2-year, and the fact that the Fed is obviously going to be raising rates in a potentially slowed down economy, right? So as we've discussed on this channel before, the inversion between the 10-year Treasury and the 2-year Treasury, where the 2-year Treasury, the yield is actually better than the 10-year Treasury, which sounds illogical, but such is the case when the bond market does project a recession. People start pouring into the 10-year Treasury and ignoring the 2-year, which raises the rates of the 2-year, and it finally surpasses the rates that the 10-year pay out. That is usually the first major warning signal of a recession. This has inverted a couple of times last week in flashes, but this has been the first full day of inversion, and we are still inverted. So this is no longer just a flash in the dark. This is a full-on inversion. But if you've been watching this channel, you know that since 1955, the economy has fallen into a recession within 7 to 24 months. So this projection by Deutsche Bank is not unfounded and really not implausible or unrealistic. If the Fed is going to continue on with its aggressive tightening policy, and it should, because inflation is running rampant, and we are expecting that the Fed is going to raise rates more than 6 or 7 times this year and raise rates for the foreseeable future in order to combat inflation, well, they are doing so when the market is coming from record GDP growth, record unemployment, and will likely start going down gradually from there in terms of these markers that measure how strong the economy is. And now you're going to be raising rates against this slowdown in the economy. We usually don't have that historically. Even when Paul Volcker, the former Fed chief back in the 80s, was raising rates aggressively, we were doing so in an economy that was running hot, not an economy that was decreasing in terms of GDP growth. But as you guys know, we're also looking at the 10-year and 3-month, because this is really the predictor of a recession, at least a better timely predictor of a recession. And this curve is actually widening, not flattening. And usually this starts to flatten the closer that we get to a recession. So 2023, 2024, if it is going to happen, does make more sense than this year, especially if we're taking this marker into account as well. Now, one thing that the Fed telegraphed today, and you guys know they are awesome at telegraphing, is that they are now looking at potentially tackling the balance sheet portion of the Fed tightening policy more aggressively. I've talked about this ad nauseum. I don't want to get too much into the weeds, but the Fed has a $9 trillion balance sheet. And what happens, when they start tightening policy is they have to start selling those treasuries back to banks in exchange for cash, because they want to take money out of the system. So they sell these treasuries at an incentivized price back to the banks, and the banks give them cash for these treasuries, right, in exchange for a higher interest rate back to the banks at some time in the future. And they're taking money out of the banking system. They're taking liquidity out of the banking system, which is what needs to happen in order to try and fight inflation. You have to take money out of the economic system. So one way they do that is by selling assets off of the balance sheet, assets that they've been buying aggressively, right? So the Fed today, one of the Fed members was saying that they're now potentially looking at more aggressive selling of the balance sheet this year, something that Jerome Powell was very tepid in communicating. He was saying that we would see a balance sheet runoff after all the Fed hikes, the Fed rate hikes are done. And now the Fed is saying, or at least one member of the Fed is saying that, hey, we could actually tackle this a lot sooner and a lot more aggressively. Now, as I said, we have the Fed meeting minutes that is going to be released April 6th, as of the time of this recording, at 2 p.m. This is 2 p.m. Eastern time, so watch out for this. This is the full detail of the meeting minutes from the March Fed meeting, which is very important because it will give us more insight into the balance sheet runoff scenario, or whether the Fed has actually discussed in more detail attacking the balance sheet portion of the Fed monetary policy more aggressively. Now, as I said, next week we also have the CPI data release. That is April 12th. And this is going to be one of the most important prints. I think every CPI print going forward will be, but we want to see print by print whether we will actually ever see a decline in inflation. Inflation just continues to rise year over year. But what we want to see is, hey, are we actually going to see a slowdown in inflation? Because if this print comes in a lot hotter than expected once again, and inflation is still on an upward trajectory, then the Fed will definitely not only hike rates more aggressively, but now start attacking the balance sheet, as we just discussed in the last segment. And what that would mean for stocks is we will likely see a drawdown. And I'm looking at this level here on the S&P 500 very intently. This is called the golden pocket. I'm not going to bore you with the details here on Fibonacci levels, but there's a reason that the S&P 500 is consolidating here, right? And it wants to see what is going to happen with the Fed meeting minutes, what is going to happen with the CPI data, and we will likely get an impulsive move one way or the other based on the outcome of these factors. And lastly, don't forget, second to lastly, don't forget that the earnings season, the major earnings season, is about to kick off soon. This is going to be the first numbers that are showcased from 2022. Obviously, we had earnings in the beginning of the year, but those were from fourth quarter 2021 and don't reflect what has been happening in 2022. However, we will get a glimpse into how the geopolitical issues with Russia and Ukraine have affected the market, how the further price instability has affected the market, how the further supply shocks to things like semiconductors have affected the market. So this is obviously going to be the most important earnings season so far in 2022 because it is the first one that is showcasing 2022 numbers. So we want to take a look at that in conjunction with the CPI data, of course. And lastly, as we mentioned, April is considered the best month for stocks, especially as we look at the S&P 500. The S&P 500 has closed positive 15 of the last 16 years. Now, here's the one caveat with April being the best month for stocks. Obviously, all of the factors that I just talked about are very important and in the short term going to affect how the stock market performs. But at the end of the day, the stock market loves one thing and one thing only, and that's, can the stocks listed in the stock market produce the earnings that they project, and can they give the guidance that we expect them to give? That's really it. That is what makes stocks continue to go up, is because the market believes that these companies will remain valuable and their earnings will continue to grow as along with their profitability. So if this earnings season shows some perseverance and some way of overcoming the supply shock issues that we've had, as well as the price instability issues that we've had, and the fact that commodities prices have just risen all across the board, as well as the geopolitical implications, especially when it comes to a commodity like oil. If the mega cap companies can persevere in that environment and produce better than expected earnings, then we will likely see a continuation of that April trend. And as I said before, especially after the 10-year and 2-year yield curve inverts, the market tends to make new highs before a recession is ever in the distance. So anyway, traders, that is it for this video. If you get anything out of this video, leave it a big fat thumbs up. Leave it in the comment section below. Let me know what you think of these factors that I outlined. Let me know what you think the prospects of a recession are. And let me know how you're trading and investing during these crazy times that we are in. If you want access to all of our trades, all of our options trades, hedges, long-term, etc., link is in the description below. Would love to have you. Come be a part of the community. Subscribe to the channel. Hit that notification bell. Stay safe out there, traders. Peace.